Today, looking past Hopium towards real numbers. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the value of stocks are driven partly by momentum, though perhaps we should really call this Hopium, as it's really investors betting with their gut, and the cold, hard realities of financial results. Markets have been leveraged higher by rate cut expectations and the prospects of AI, but when the numbers come in at the results time, sometimes Hopium goes away, especially when bond yields take the discount rate higher, with the US 2-year currently at 4.925% and the 10-year at 4.646%. And of course, that reduces the future value of earnings. And we've seen this with the Magnificent Seven, as Tesla stock actually jumped 12%, rebounding from a 15-month low earlier in the week, after the electric vehicle manufacturer said it was accelerating the launch of new EV models, including more affordable options, to the second half of 2025. But at $162.10, it's way down from its high of $298 from July last year. And the latest was Meta, which closed in New York down just 0.52%, but in after trade it slid 15% after it forecast softer than expected second quarter revenue on increased costs of artificial intelligence. The weaker guidance and ramp up in spending offset the quarter one results, which beat analysts' estimates. For the 3 months ended March 31, Meta reported earnings of $4.71 per share on revenue of $36.46 billion. Analysts had anticipated EPS of about $4.32 on revenue of $36.14 billion. Family daily active users, or DAP, was 3.24 billion on average for March 2024. That was an increase of 7% year over year. But for the second quarter, the company guided total revenue to be in the range of $36.5 billion to $39 billion, or $37.75 billion at the midpoint, missing estimates of $38.3 billion. The weaker than expected revenue outlook comes as the company now expects full year 24 capital expenditures in the range of $35 billion to $40 billion. That's up from a prior range of $30 to $37 billion, as the company said it will continue to accelerate infrastructure investments to support artificial intelligence. The ramp up in spending on AI chips and data centers could weigh on margins, and not only stifle the social media giant's innovation roadmap, but also potentially pressure user acquisition spending. Investors are pricing in tighter margins for Zuckerberg's company than previously expected, which means fewer competitive advantages, particularly in the innovation field, both VR and AI, according to one analyst. The higher spending will fatally lead to less user acquisition spending, and growth in this area could very well hit negative numbers next quarter. Still, it may be too early for investors to hit the panic button, because several of the growth drivers are likely to produce pickup throughout the year as the company implements less ad-reliant monetization strategies. So, as the analyst at Evercore said in the note, we think that the stock reaction after market is a reflection of the very high expectations for Meta heading into print. But more generally, this does raise concerns about how much earnings potential AI does hold for technology companies, given that it also comes at a much higher cost. Meta's outlook will set a dour tone for upcoming earnings from Microsoft Corporation and Alphabet. And we should also be considering the banking sector, which has been driven up by Hopium too. Bank earnings ahead will be one to watch. For example, Barclays reported a 12% fall in first quarter profits on Thursday, as a squeeze on UK mortgage pricing, lower income from trading, and a drought of mergers and acquisition fees showed the difficulties it will face in delivering its first strategic revamp in a decade. Yet in London, its shares rose to £199.02, after the result. In contrast, the FTSE was up just 0.72% to 8,098 in morning trade. That's a new high, but again, it's best to look past the hopium to the numbers. The British Bank reported pre-tax profit for the January to March period of £2.3 billion. That's down from £2.6 billion a year ago and narrowly above analysts' forecasts. Barclays is bidding to restore investor faith in its universal banking business model after years of share price underperformance, including clashes with activists over the role of its investment bank and management turnover. The British Bank said in a long-awaited strategy review back in February that it would invest in its high-returning domestic banking business, as well as axing £2 billion of costs and revamping up payouts to shareholders. And the results update on Thursday was the first under the lender's new structure, reorganised into 5 operating divisions instead of 3 in an attempt to provide clearer disclosure on performance and management accountability. The lender now reports results for Barclays UK, Barclays UK Corporate Bank, Private Bank and Wealth Management, Investment Bank, and US Consumer Bank. All 5 business divisions reported lower returns on tangible equity than their first quarter 23 comparisons, with the UK Corporate Bank the laggard of the set, posting the ROTE of 15.2% from 21.7% just a year ago. Income in the UK Bank division, which specialises in consumer and home loans, fell 7% amid increased competition in the mortgage market and as savers moved money to higher returning products. Total investment bank income also fell 7%, just shy of expectations, and the unit's overall ROTE of 12% was 2.4 percentage points lower than the first quarter of 2023. Still, the performance of the under-pressure unit was actually in line with its long-term target. And Barclays said its income in its traditionally strong fixed income currencies and commodities unit fell 21% as clients' trading slowed and against a stronger year-ago comparison. Investment bank advisory fees slid 30% as it failed to capture merger advisory fees. And equities revenue rose 25%, meanwhile, as the bank performed strongly in both its derivatives and cash equities trading. And Barclays investment bank performance overall lagged rivals on Wall Street, where the top 5 players on average saw the FICC trading revenues drop 3%, equities rise 6%, and investment banking fees rising 25%, according to research from Jefferies. And by the way, rival Deutsche Bank on Thursday posted a better-than-expected 10% increase in first quarter profit, citing a bounce back in fixed income trading and deal-making revenue at its investment banking division. And Barclays also said that on Wednesday it announced its Irish unit, which houses much of its European business, would sell an Italian retail mortgage book in line with aims to simplify its exposures. The deal will conclude in the second quarter of this year and generate a pre-tax loss of around £225 million, and it'll be neutral to the bank's capital levels. Now, ahead, I think we need to watch the trajectory of both big tech and big finance as realities begin to dawn. The truth is that higher for longer doesn't necessarily mean more momentum for the banking sector, and the prospect of big capital expenditure to try and capitalize AI has still to be translated into income generation. So that's why I think there's too much hopium out there still. And talking about hopium, Bitcoin price fell on Thursday, hit by weak risk appetite as a rout in major US technology stocks spilled over into crypto markets, while anticipation of more clues on interest rates also weighed. The world's largest cryptocurrency fell 4% over the past 24 hours to around $63,800 US. Bitcoin generally tends to track momentum in US technology stocks, given that both sectors are viewed as opportunities for high returns, but also speculative investments. This trend, though, had petered out earlier this year, especially following the launch of spot exchange-traded funds in the US, and that sparked short-term outperformance in Bitcoin. But Bitcoin's correlation to tech has been seen to be coming back into play in recent weeks as the hype over the ETF dwindled and as both sectors faced renewed price pressures from the prospect of higher for longer US interest rates, and also means the recent halving for Bitcoin may not lead to price rises. In fact, Bitcoin is down about 8% over the past month, compared to a 4% drop in the tech-heavy NASDAQ futures index. The cryptocurrency has also remained in a trading range of between 60,000 and 70,000 US after hitting record highs back in early March. And finally, most Asian stocks fell on Thursday, with technology shares tracking losses in their Wall Street peers following disappointing guidance from internet giant Meta Platforms, while fears of higher for longer interest rates in the US remain in play. Japan's Nikkei 225 index was flat, actually, on losses in heavyweight technology stocks, and the broader Topex fell 1.1% as sentiment towards Japanese markets was also dented by anticipation of a Bank of Japan meeting on Friday. While the Bank of Japan is widely expected to keep interest rates unchanged after an historic hike in March, markets were wary of any hawkish signals on inflation, especially following recent signals of improved wages growth and resilience in the Japanese economy. Tokyo consumer inflation, by the way, is also due out on Friday and is expected to show a mild pickup in inflation through April. South Korea's Kospi fell 1.8% on Thursday, weighed by losses in technology stocks as a weak lead-in from Wall Street largely offset positive earnings and economic data. Memory chip maker SK Hynix sank 3.3%, despite clocking substantially stronger than expected first quarter earnings on AI-fueled demand. But the chip maker also forecast increased expenses as it ramps up output to meet an expected jump in demand. And peer Samsung Electronics fell 1.9%. The two stocks are by far the biggest on the Kospi. Weakness in technology stocks offset optimism over gross domestic product data, showing that the South Korean economy grew 1.3% in the first quarter. That's twice higher than expected. Other Asian markets were somewhat mixed. China's Shanghai Shenzhen CSI 300 and Shanghai Composite Indices fell just a little, while Hong Kong's Hang Seng Index extended a rebound to hit 5 months high. And India's Nifty 50 was up 0.79% as sentiment towards the country cooled before its 2024 general elections, which began last Friday. The incumbent BJP party is expected to clinch a third consecutive term. Australian markets, of course, were closed for the ANZAC holiday, and we will remember them. And ahead, markets are also waiting more clues on the US economy and interest rates from upcoming data prints. US gross domestic product data is due out later on Thursday and is expected to show just how resilient the US economy remained in the first quarter. More closely watched will be the PCE price index data, which is due out on Friday. The reading is the Federal Reserve's preferred inflation gauge and is likely to factor into the central bank's plans for interest rates. But, as Warren Buffett says, when the tide goes out, we can see who is swimming naked. To which I would add, when the tide of hopium goes out, we can see what realities lie below the waterline. And it may well not be pretty. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.